Hi, I'm Claire Trott from Technical Connection. I'm here today to talk to you about the pension changes that did or didn't really happen in the spring statement. So there was less than 10 mentions of pensions in the statement report itself. So you'd think at that point, well, nothing's really happened. But as we know, pensions actually have a knock-on effect from other things that happen. So we're seeing in 2 years' time a reduction in the basic rate of income tax from 20p in the pound to 19p in the pound. So what will that actually mean to people who are contributing to pensions? Well, in essence, very little for higher or additional rate taxpayers, because what you do is you get your tax relief on the top part of your earnings. So they're still going to get 40 or 45% tax relief. However, the amount actually going into the pension will change. So what we'll see is 19% uplift of money going into the pension. So the amount they actually get back through self-assessment will be higher and the amount going into the pension will be lower. So it's only 1%. It's not going to make a major difference, but it might just be something to consider when they're working out what their funding levels are when they're going in, because actually you'll need to pay in more to get that gross contribution up to that 40,000. So all our calculations that we do, all those nice round numbers that are on 20%, is actually just going to have to all be changed, and we have to do those calculations again. So those figures that we know, for example, for those people who are non-taxpayers, 2880 grosses up to 3,600, the amount that you could pay in for a child or a non-taxpayer. That figure's going to change. That figure's going to go up. So if you are paying in for children or thinking of paying in for children or non-taxpayers, getting that money in sooner will actually save you 1%, because they're not paying tax, but they will be getting tax relief at a lower rate after the 2 years, so in 2024 going forward. Again, basic rate relief will get that 19% going into the pension. So again, maximising what can be done in the next 2 years, well, this tax year and the next 2 years, is really important, just to get that extra 1%. But actually the flexibility for those people who are basic rate taxpayers is significantly less than we've got for the higher or additional rate, mainly due to the fact that if you're going to be a basic rate taxpayer, you're not earning more than 50 or so thousand. So you're not going to have lots of carry forward that you can utilise, because you need to have earnings to support those contributions. The next thing that we're thinking about is, obviously we've got the national insurance increase on the primary threshold. So what that will basically mean for most people is they're going to be paying this £300 less. So people have sort of said, well, does that change what we're going to do with salary sacrifice? No, salary sacrifice on pension contributions still really important, getting that value, especially as next year we're actually seeing the rate at which you pay national insurance increasing. So it's going up 1.25% on employer and on personal to cover the health and social care levy, but it's all in national insurance next year. It's only the following year where it becomes a separate levy, where we take account of it in a slightly different way and becomes a tax in its own right. When we're also looking with national insurance and profit extractions, pensions still win. You've got all these different moving parts, and it's worth considering the best way to take money out of your business when we're factoring in those increases in national insurance, increase in the dividend rates, and there's actually no change on the pensions. You're still going to have that benefit of employer pensions, not paying any national insurance and not paying any corporation tax, because it should be an allowable business expense, although we just need to be sure and check with the accountant, always something to remember. Although we're seeing that increase individually on the amount you can earn before you start paying national insurance, the amount that employers pay before they pay national insurance actually hasn't changed, or we haven't seen the fact that it's going to change. So that's still at the 8,000 or so level. So people may still want to consider only taking that 8,000 up to that in order to get their national insurance credits for their state pension, but not paying any national insurance on the employer side. If they want to take a little bit more salary, then you've also got that buffer. So they'll pay national insurance on the bit over and above the 8,000 or so, but they can take earnings up to 12,000 without paying any personal national insurance. So there's even more moving parts to consider. And then when we get into the changes in corporation tax, then again, there's going to be more things to consider. So the good thing here is people need advice to decide how best to extract their profits from their business. So although there was very little in the way of pensions actually in the spring statement, it just gives you more things to talk about and a conversation to have with different clients, so the basic rate payers, the higher rate payers, additional rate payers, as well as your small business owners, to decide how you want to deal with this in the next 2 years before the changes in income tax, and in the next year before we see different changes in the national insurance. So lots of things to think about, even though there was nothing directly related to pensions. Thank you very much.